Hello viewers and welcome to Stock Tech. Today we have come up with a video on the basics of stock market. As you can read on the screen, we call it a layman's guide to the basics of stock market. In this video, we'll be learning the basics of investing and trading. This is an on-demand video that we have created looking at the current situation where a lot of people are moving towards the stock market and considering stock market to be a source of income. So this video has been created keeping in mind that a lot of beginners who have totally zero knowledge about the stock market are in search of material, in search of videos that would help them understand the stock market better. So we have come up with an aim that we can explain stock market to everyone watching this video in a very basic and simple language which any layman can understand. In this video, we might have not used a lot of technical or fundamental words, right? Those are the words that are related to the stock market, but we have tried to keep it as simple as possible. And we have tried to explain in such a way by relating it to the real life examples and real life scenarios around you. We would like to tell you one thing, that at the end of the video, you will have a very systematic approach to the stock market, which you will not find anywhere else. We have given you a step-by-step systematic approach to analyze or read the stock market. So this video will completely change your approach towards the stock market, and any beginner, irrespective of whichever profession or field you are from, if you have any prior knowledge about the stock market or you're a complete beginner with no knowledge about the stock market, you can still watch this video and understand the stock market better. So before we go forward, let's go through the disclaimer. And as I told you, we have come up with this basic course in layman's terms, so it can help even the beginners who are hearing them for the first time. From this video, we do not assure that you would master the techniques of trading or investing. We do not even guarantee any kinds of returns after watching this video. Stock market investments are subjected to market risk, and we request you to consult your financial advisor before taking any investment decisions, and read the disclaimer completely before you go forward with watching this video. Having said that, let me ask you guys a question. Today, we see around us a lot of people, whether they are doctors, engineers, teachers, businessmen, or even the students or your super moms who are sitting at home, are moving towards the stock market. This thing has recently happened to our society, that everybody is considering investing in the stock market. So when they are considering investment in the stock market, I would like to analyze the reason behind it. Why are they considering to invest their money into the stock market? There's one simple question that we need to ask. These people are into different professions, different types of work they do. They have a different source of income, which varies. A lot of them are doing very well. They are earning good income. Whether the doctors, the businessman, they are making healthy money every month. But are they happy after spending what they are saving? Now, if you go to a person with a 30, 40, 50K per month, the person also spends in such a way that at the end he's left with very small amount of savings. You go to a person who earns 5 lakhs per month, and this person also spends in such a way that he is also left with a very small amount at the end of the month. So according to the income that we generate, our lifestyle also changes and our expenses also increase. So when I ask the question, are people happy with what they are saving, then the answer might be a no, because a lot of people are happy with what they are earning, the packages they are getting, they are satisfied. But with those packages, their life standard has gone up and they are not able to keep up with the expenses, and obviously they are not happy with the savings that they make. Why is this happening? Because in today's expensive world, the costs have gone up drastically, but the incomes have not. If you want to buy a house or a land today, you know what is the situation. You know the medical expenses, the school fees of your children, this has gone up drastically. So your day-to-day life expenses, we have come up with so many new things, where everywhere money is required, and these things have become a part of our daily life. So what happens at the end of the month? At the end of the month, you are just left with bills and bills, and eventually you are into debts. So to overcome all these issues, people are looking out for a secondary source of income. Okay, so there are various options for a secondary source of income, like you can invest in real estate, you can invest in gold, you can go for the mutual funds, or you can invest in the fixed deposits as well. So according to everyone's convenience, okay, individual convenience, people are looking out for sources of income where they can invest and they can make money out of it. But all this secondary sources of income comes with limitations. Okay, I'm not talking about risk and reward. See, because any investment comes with risk and reward. So if you're investing in real estate, you have the risk, you have the reward. If you're investing in gold, you have the risk, you have the reward. If you're investing in mutual funds, obviously you have the risk and the reward. So any investment you do, you have the risk as well as the reward. So this is a part of the game. The profit and the loss is a part of the game. I'm talking about limitations other than this, and the limitations that we face other than this is, like, for real estate requires heavy investments, gold has security issues, mutual funds time waiting period is higher, and fixed deposits you have low returns. So each of this investment has limitations. Plus, the investor also faces a lot of limitations with flexibility of time and flexibility of where he is, how he's working, and many other things. So now, what can be a better solution? So if you ask me, I would tell you that stock market is the best source of secondary income for any individual, any working professional, whichever background you belong to, it doesn't really matter. You can learn and earn in the stock market. Having said that, you guys would ask a question, okay, he is talking about stock market because he is into the stock market, right? But let me just prove it to you with simple logical examples. No facts, no figures, no technical stuff, just simple logical examples. Before understanding why stock market is the best source of secondary income, first let's understand what is stock market. In simple words, a place where buying and selling of shares and stocks takes place between traders. So what happens if you go to a vegetable market? If you go to a vegetable market, there's a vegetable seller, there's a vegetable buyer. The buyer gives the money, the seller gives the vegetables. So buy and sell takes place of vegetables. So like any other market, the stock market is also a place where buying and selling of shares or stocks takes place. All we need to remember as of now is just this, that a place where buying and selling of stocks or shares takes place. So there's a buyer who wants the stocks, there's a seller who wants to sell the stocks for money. So the buyer is gonna give the money, take the shares. The seller is gonna give the shares and take the money. That's it, like any other market in the world. This is what stock market is all about. Okay, now the question comes up. I know what a fruit is. I know what a vegetable is, but I really don't know what a share or a stock is. Okay, so we will come see that in the upcoming part. But as of now, we only know that a place where buying and selling of stocks takes place is known as a stock market. So why investing in the stock market or buying or selling in the stock market is the best source of secondary income for anyone? In the stock market, you have flexibility with everything. For example, you can start with minimum investment. And trust me, there's no limitations to the minimum investment. You have shares worth 1 rupee, and you can buy one share worth 1 rupee and hold it. So you can start your investment as low as 1 rupee. Yes, that's actually true. But yes, obviously, if you are investing 1 rupee, the returns also you have to expect accordingly, right? But that's true that you can start your investment as low as 1 rupee in the stock market, and there's no issues with that. The returns are very high comparatively to compare to any other source of investment is what I feel. It's a very user friendly field. Anybody can do it who has basic knowledge of how to use a smartphone, a laptop, a computer, and an internet connection. That's all is required, and anybody can use it. It's so user friendly, and you don't need to be present at a particular location to trade in the stock market and make money. You don't require any physical storage to hold whatever you have bought, the stocks you have bought. And plus, the best part is there's no boss, there's no labor. You are the boss, you are the labor, and you're working for yourself. Now, when I say minimum investment, as I told you, there are shares worth very small prices and very big prices as well. Like for example, on the screen, I have a share Gammon Infra, which is 2 rupees 95 paise, and MRF, which was 66,871 rupees. So you have shares ranging from 2 rupees to 66,000 rupees. So you can start your investment as low as 2 rupees, or you can start your investment as high as 66,000 per share. Now you buy 100 shares of 2 rupees 95 paisa each, or you buy 10 shares of 66,000 each, or you buy one share of this, or you buy 5 shares of this. That's completely on you guys. There's nobody who's going to stop you from doing that. There's nobody who's going to tell you what amount you have to invest, how much you have to invest. You can start investing with pennies. Okay, nobody is going to stop you, right? So there's no restriction to your investment. Now, talking about the returns, a lot of people give us an example where they say that if you invest for long term in the stock market, you are going to get very good returns. And they like kind of assure it that you invest in the stock market, buy the stock, forget the stock for years together, and you are going to get very, very high returns out of it. This is not actually true. I'll tell you why. First, let's see what example people give you. People give you an example of like a Maruti 800 car. If you had bought a Maruti 800 car back in 2003, the value of that car would be 2 lakh rupees. So you would pay 2 lakh and buy a Maruti 800 car. And today, if you try to sell it, the value would be 25,000 rupees. So what example we get is instead of buying the product, that is the Maruti 800 car, if you had actually bought shares of Maruti Suzuki, the company that makes the cars, same amount worth 2 lakhs, today's value would be 1.5 crores. So this is an example you get. You invest for long term and you get very, very good returns. But what people don't tell you is if you had invested in a stock called Reliance Communication back in 2007, the stock was trading at 700 rupees, and today the stock has come down to 2 rupees. So anybody who made an investment of even 7 lakh rupees, today's value would be 2,000 rupees. This is the situation of the stock today, right? So if somebody, just imagine with an intention that I want to just invest in long term and invested back in 2007, 7. Now the stock starts going up, reaches the peak, but this person is holding on because it's his long-term investment, and then the stock keeps going down. He keeps hoping that someday it will come up because it is his long-term investment, and he doesn't sell the shares, and eventually the price of the stock goes down and he loses almost 90 to 95% of his capital. In fact, 100% you can say capital he loses. So this part over here is also true, and this part over here is also true, right? So anybody, if they invest their money for a stock for long term and they forget the stock, there are two things that can happen. The money can multiply multiple folds, agreed, or it can go down drastically. So we say long term is not a assured key to the treasure in the stock market. Having said that, then what do we need to do if you want to trade in the stock market? If you wish to trade in the stock market, you need to ask 3 questions. Which stock should I buy? At what price should I buy? And at what price should I sell? These are the 3 questions that you need to know. So for example, let's say you are buying a XYZ stock at 100 rupees, and then if it starts going up, you should know at what price you should be able to sell it, and if it starts coming down also, you should know at what price you should sell it. So these are the 3 questions that need an answer, and if you're able to answer this, you will be going in the right direction. But saying that is very easy, that find the exact buy price, the exact sell price, and which stock to buy. Saying that is easy, but finding that out in the stock market, is it difficult? No, it is not difficult if you go with a step-by-step solution to it. Let me give you an example. A lot of people who are watching these videos might be completely beginners. Some of you might have experience, and some of you might be traders as well. So I'll not talk about the trading side. I'm going to ask you a question about investing in a flat. Let's consider you want to buy a flat. Okay, you have some money and you want to buy a flat. Now, when you want to buy a flat, what is the first thing that you have to decide? The first thing you have to decide is, in which city should I buy the flat? This is how exactly your approach starts. Let's assume you are a person locally from Mumbai staying in Bangalore. So now you have to decide whether you're going to settle down in Bangalore, Mumbai, or you want to move to some third city. If you want to buy a flat, the first question is, which city should I buy the flat in? So that would be the first step, selection of the city where you want to buy the stock. Now, once you have selected the city, let me assume I'm going for Bangalore. So when I'm going for Bangalore, now in Bangalore, there are so many areas. So obviously anybody who wants to buy a flat, they will look for the city, and after the city, they will select the particular area they want to buy. So there's an XYZ area. Let's say we have selected that area. Now in that area, based on the facilities, amenities, and ease of traveling, convenience, and close by to your workplace, and considering so many other factors, you will select the best apartment, selection of apartment. And then based on the apartment that you have selected, you will decide which floor and which flat you want. So this is a 4-step systematic procedure. So let's say you cannot just pick any flat or a floor and then place it in some of the building you like and pick that building and place it in some city, right? No, obviously we cannot do that. So we have to go step by step. And when I say we have to go step by step, I mean to say with the systematic procedure. Let's assume you want to buy a car, guys. Again, it's a 4-step procedure. First thing I'll do is I'll decide whether I want to buy a SUV, a sedan, or a hatchback. Once I have decided the type of car will be the first step. Once I've decided the type of car, the next thing I'm going to look for is the brand, whether I'm going for Maruti, whether I'm going for Hyundai, whether I'm going for Audi. So you decide the brand depending on your budget. Once you have decided the brand, the next thing you decide is the model. In that particular brand, you will have many models. If you're selected hatchback, let's say, so you'll have many models in the hatchback. So you'll decide the model which you want to buy. And in that particular model, you will have different variants, like the top end, the mid variant. So you will have different variants. So again, 4 steps. If you want to buy jewelry, guys, let me give you an example. You will first decide whether you want to buy a gold, silver, or diamond. Step number 1. Step number 2, now from where do you want to buy it? Which brand, which store? Step number 3, you will go to the store and you will decide what type of jewelry, casual wear, function wear, or daily wear, what type of jewelry you want to. And then finally, the design. Okay, so while considering the various factors, you consider everything, your budget, and everything is considered side by side. But the main procedure, systematic procedure, is 4 steps. Exactly buying a stock can be related to this. It's something that we do in our daily life. Only thing we think that stock market is some rocket science and I will not be able to follow it. I'll not be able to do it. Let's just use your simple day-to-day life logic in the stock market and see the results. Okay, now let's concentrate on buying a stock. So if I'm concentrating on buying a stock, the first thing that I will be looking at is which city should I buy the stock. So selection of city. In the stock market also you have different cities. These cities are basically known as segments: equity segment, forex, derivatives, your commodities. So various segments, we'll be seeing them in detail one by one. So first thing is selection of segment. Under this segment, the next thing you have to select is the area, and that is your sector. For example, let's say I go with the equity segment. That's your city. Equity will be a city. And under equity, you will have different category of stocks, like companies that are manufacturing medicines. So we will call them pharma stocks. Companies, those are manufactured into the IT services. We will call them the IT sector. So you will have various sectors like this: energy sector, industrial sector, fast moving consumer goods sector. Okay, your auto sector, companies that are manufacturing automobiles. So you will have sector. In that particular sector, you, for example, let me go with automobile sector. Let's say I've selected automobile sector. In that particular sector, you will have a lot of companies. So again, you have to select the best company. And when you select the best company, the last part will be, in that best company, what level should I buy the stock? Exactly the same. City, segment, area, sector. Apartment is the best company, and the floor or the flat is the level you want to buy the stock at. So exactly the same procedure. So anybody step by step systematically understands this 4 stages will also understand how to go forward with perfect trading or investing of stocks. Let me tell you one thing: whether you are investing or whether you are trading, the first 3 steps remains the same for you, and the final step changes. In today's training, we will see what is selection of segment, selection of sector, selection of best company, and selection of levels, step by step. So let me go to the first step, that is the selection of segment. That is deciding in which city I want to buy a flat. So there are different cities in the stock market. They are known as segments. You have equity segment, you have the commodities segment, you have forex, derivatives, and many others. But I've just selected this 4. Now let me tell you what are the segments one by one. Equity segments. What are equities? In simple words, not going too much into technical details, I'll give you a simple example so that you can remember this. Company stocks are called equities. Just remember this. So when I say Tata Motors, it's a company stock. You call it equity, right? So when whichever company name you take, these are called equity stocks. Ajanta Pharma, Divis Lab, Cipla, Reliance Industries, Tata Communications, Idea, Havels. You might have seen fans, etc. in your house. Havels, Crompton, Bajaj, right? These are household names that I'm taking. And Asian Paints. So whenever I take this names, these are companies that manufacture some products, okay, and or into services also. So the shares of this company, when you try to buy and sell, this is called trading in equities. Simple. Okay. Now, when I say commodities, trading of your natural resources like crude oil, gold, your metals. So trading, that is buying them online and selling them online. So when I'm saying you buy crude oil, you buy it online, you are selling it online, right? So commodities trading is the trading of natural resources, you can say. Forex trading. Forex trading is the trading of currency pairs. For example, you are trading the foreign currencies, dollar, dirham, dinar, euro, yen, etc. This comes in pairs, so you are trading them. So that is forex trading. Derivatives trading. Let me go by the name itself. Derivatives, derived from something. Like you have groundnut oil derived from groundnut. Similarly, you have derivatives derived from something. They are nothing in actual, you can say. So if you don't have groundnut, you will never have groundnut oil. So derivatives is like that. This is a segment that is derived from equities or commodities. So this is a derived segment. Okay. Now this segment is very, very risky for the beginners, especially. Okay. And trust me, a lot of people just enter stock market from this door and they are kicked out of the stock market from this door. But when they are kicked out of the stock market from this door, they have lost all the money they had. So my request to all the beginners or even people trading, not just beginners, we do not recommend trading in derivatives at all, because derivatives comes with lot sizes. I'll give you a simple example. Let's understand this. If you want to buy Ashok Leyland in equities, you can buy whatever quantity you want to buy: one quantity, two quantity, three quantity, four quantity. But if you want to buy it under derivative segment, you don't decide the quantity. The stock already comes with a lot size and you have to buy according to that lot size itself. Like for example, idea is a 7 rupee 8 rupee stock today. So if you're trying to buy idea in equities, you can buy one quantity, but if you're trying to buy it under derivatives, you have to buy minimum 1,40,000 quantities. That would be an investment of somewhere around 8 to 10 lakhs. You have to invest that much amount minimum. Okay. Next thing, if you buy equities, you can buy it today, you can sell it tomorrow, you can sell it day after tomorrow, you can sell it after a month, after a year, after 10 years. That doesn't work with derivatives. Derivatives come up with the expiry. After that expiry, it becomes zero. So there will be no value for that particular derivative that you're buying. So derivative segment is a very, very risky segment. I would say all of you should stay away from this. Okay. So what is the best segment then out of this? According to me, I can tell you that my city or my preference is the equity city. One of the best, the most consistent segment that you have. That is the equity segment. In this segment, you are the one who decides. You are the boss. You decide what quantity you want to buy. You can buy one quantity, 10 quantity, 100 quantity, 1,000 quantity, 10,000 quantity. You decide how long you want to keep it. You want to keep it 1 day, 1 year, 1 month, whatever it is. Or you never want to sell off the stock. So basically, you are the boss. You are the one who makes the decisions. Okay. Now, if you compare equity to any other investments over last 10 years, you will see equity has given anytime better gains than any other source of investments. Right. So let's go with the best, the safest, and the better city, that is equity city. So my segment, out of all segments, we will be concentrating on the equity segments, right? So when I say equity segment, let's learn a bit about this equity segment in detail. What is equity segment? I had told you that equity segment are company stocks. So for example, the capital raised by a company or corporation through the issue and subscription of partnership bonds. Okay. So when a company wants to expand their business, they raise funds through the issue of partnership bonds. Let's try to understand this with a simple example. Let's say there is a XYZ company. XYZ company. Okay. So now this XYZ company is into certain business and they are doing really good. Now the market value of this company or market capital of this company is 10 lakhs. So first of all, what is market capital? If you go by the technical definition, is the current value of the share into number of outstanding shares. Most of the beginners won't understand this. So I'll give you a simple example and let's try to understand with that. Let's say you have a company and this company has a office. They have the furniture, they have the computers, the laptops, they have everything that is required, like a TV, let's say, everything. They have some virtual property, like some patents, some trademarks. So everything a company has, if I sell the company into the market with everything it has, and whatever price I am getting is known as market capital. Not exactly a technical definition, I can say, but for your understanding, it's the best thing as of now. We will see the exact definition in the coming part. So let's say this company is worth 10 lakh rupees in the market. Now it's running its business in one city. Let's say the company is established in Bangalore. Now the company is planning to expand its business to Mumbai. So when they are planning to expand their business to Mumbai, what they need is funds. So let's say they need another 10 lakh rupees to expand their business in Mumbai. So they check their bank accounts, and out of the years of business that they have done, let's assume they have 5 lakh savings, which they are planning to invest into the business and expand their business. But they still require 5 lakhs required, because total requirement is 10 lakhs. 5 lakhs they can fulfill from their savings, and 5 lakhs is what they require. Now to get this 5 lakhs for the purpose of expansion from Bangalore to Mumbai, okay, what can they do and how can they obtain this 5 lakhs that they require? There's many options to this. They can sell some asset if they have an asset. So if they have some property, they can sell the property and get those funds. Second, they can, basically go for borrowing. So let's say you are the owner of the company, so you can just go and borrow from your friends, family, etc. Third, you can go for bank loans, right? So people have various options like selling assets, sell assets. Okay. Then you have borrow. Okay. And lastly, you can go for bank loans as well. Bank loans. Now, each of these options has certain restrictions with them. For example, selling an asset for the expansion of business is never considered a good option, because let's say you sell your asset and you go to Mumbai and start your business. Now your business doesn't work out well in Mumbai. You lost the business, you lost the asset. So not a good option, right? And again, depends on what kind of asset you have, liquidity, and how fast you are able to sell it. So there are many other limitations to this one. Now coming to borrowing. Okay, if it's a small amount, somebody might lend it to you as well. Since here I've considered an example of 10 lakhs and required amount is 5 lakhs. So I may still consider that somebody might give me 5 lakhs. But That is not how companies work. It's hundreds of crores, it's thousands of crores. Okay, so buying is, again, borrowing is out of case. Okay, I can go for bank loans. For that, obviously you need very strong documents and you need security and so many things. But let's say you pass all those. Now what you get is you get a 5 lakhs. Now when you get a 5 lakhs from the bank loan, first thing, in any condition, you have to pay back the principal amount. Correct. So the principal amount of 5 lakhs that you have taken from the bank as a loan is what you have to pay back. Plus, you also have to pay interest, right? Okay. Now, as long as your business is doing good, you would neither care about paying back the principal, neither care about paying back the interest, because you're earning, you're paying back. Now, but if your business is not doing good, you'll not be able to pay back the interest. Forget principal amount, and then there will be penal interest, and so on. The cycle keeps going on. So, what can be a better option? Even if I want to avoid bank loans, I want to avoid all this headache, then what can be a better option? I have a better option for this. And what I do is I invite 5 friends to a meeting, have a discussion with them. So let's say there are 5 friends, A, B, C, D, and E. So I give them an offer. Guys, this is my company. I've been doing so and so business. I'll prepare a project report. I'll show them how my past performance has been, and I'll also show them how my future performance would be, and how I'm planning to expand my business, what growth I'm expecting, and everything. I just show it to them. And I tell them, guys, I have an offer for you. What you do is you give me rupees 1 lakh each. Okay, so if you give me 1 lakh each, you are 5 people. Okay, so I will get whatever 5 lakhs I want to expand my business in Mumbai. Okay, so now the friends are going to ask a question: what are we getting in return? So I tell them, see, if you invest 5 lakhs in my company, today my company is what, 10 lakhs. If I expand it to Mumbai, let's say it becomes 10 lakhs. So the total market value of my company would be 20 lakhs, correct? So when I have a company of 20 lakh rupees, you are basically a person who has invested 1 lakh in that 20 lakh. Okay. So in a total market value of 20 lakhs, your investment is 1 lakh rupees. So you become a 5% partner in my profit and loss. So I offer him a 5% partnership in my profit and loss. So the investor, this 5 friends are going to ask me a question. So what are the benefits? So I tell them, see, there are various benefits. Benefit number 1 is capital gains. You will get capital gains. Benefit number 2 is you will get dividends. Benefit number 3 is you don't require to put in any effort. So no effort. Benefit number 4 is you do not have to put in any time from your side. Okay, you do not have to work for me. I will do everything on your behalf, and I will give you capital gains. I give you dividends. You don't have to put in any effort, no time, no work. Okay, now what is capital gains and dividends? If somebody doesn't know that, let me explain it over here. What is capital gains and what is dividends? In simple words, let's say you buy a flat today. You buy a flat today for, let's say, 50 lakhs. You buy a flat and you sell the flat after 1 year for 60 lakhs. Okay, assume. So whatever 10 lakhs you made is the profits. This profits is called capital gains. But let's say you had this flat, 50 lakhs worth flat, and you had rented it out for 20K per month. So you are getting this amount every month. So this amount that you are getting every month is called dividends. Assume something like this. Okay. So this is your dividends. And when you buy the flat and you sell the flat, it's 60 lakh. That is your capital gains. Now, when people trade into the stocks, okay, so you buy a stock at a particular rate, the stock goes up, the stock goes down. Now here is what gains we are trying to make is capital gains or capital losses is what people make. For example, let's say I buy here. Okay, I buy here. When I buy over here, and let's say the stock price goes up and I sell it somewhere over here, I made capital gains. This is called capital gains. So every day that the trading that happens, you buy at 100, you sell at 102, you sell at 104, you sell at 110, whatever process, that is capital gains. Now let's say if you buy at 100, let's say you buy the stock over here, okay, at some higher price, and then the stock goes lower and you sell it over here. So now you made a capital loss. Okay. What are dividends? Dividends is an amount out of the profit that company pays to the shareholders. If you are holding the shares of the company, then the company pays you certain dividends. So for example, I'll just explain it over here. So today the company is worth 20 lakhs, correct? And each investor is a partner of 5% in profit and loss because they have invested 1 lakh. Tomorrow, let's say the company grows, okay, very nicely and becomes a company worth 40 lakhs. So now the investor who had invested 5% money is still an investor of 5%, but now thus 5% is not 1 lakh anymore, they are 2 lakhs because 5% of 40 lakhs would be 2 lakhs. So this investor will be a constant 5% shareholder over here. So as the price of the company, value of the company increases, his percentage remains the same, but the value keeps increasing. And what is dividends? Whenever they want to, they pay a part of the profits to the investors. But basically, let me tell you, in trading, we are not concentrating more on dividends. The main focus is on capital gains. Whereas when you are investing, the focus is also on capital gains and also on dividends. I tell my friends, see, you have so many benefits if you invest with me. You have so many benefits. And you have only one type of loss, that if you make a loss, there's only one loss. You know which loss it is? It is called capital loss. So if the company is performing bad, you don't pay the company anything, right? You don't pay them dividend. If the company is performing bad, you won't say, okay, I'll come there and I'll work hard and make you go up. So again, everything remains constant. Only thing, if the company does bad, you will make a capital loss. Now, isn't it amazing? Why a lot of people ask me why people should invest in shares. The reason is very simple. Why people should invest in shares? You have a lot of benefits and the loss is only one type of loss, capital loss. Now, so with this 5 friends of mine, they agree, yes, your business model is good, you're really doing good, and we are getting a good offer. So let's say we are planning to invest in your company, and they decide to invest in my company. So when they decide to invest in my company, they pay me an amount of 1 lakh each. So when each of them pays me an amount of 1 lakh each, 1 lakh each, this guys pay me. Obviously, they are going to pay me through some legal bond or some agreement. They are not going to pay it to me just on verbal, right? Verbal interaction. They are going to pay it to me on some legal bond or legal agreement. And this bond or agreement is known as share, or your in simple stock, collectively stock and individually share. So this is known as equity share. So this 5% partnership bond in profit and loss in the company, okay, when I paid the company, I get the share. Now you might say, how is this mechanism exactly working in day-to-day life? For example, now you have a share of a company called Ashok Leyland. Ashok Leyland, that's 50 rupees. Okay, you have a share of stock called Reliance, right? That's 2000 rupees. Now this means this company is based on their market value. Reliance is a company worth 10 lakh crores. Okay, so based on their market value, Reliance has divided itself into so many small parts, and then because of the performance of the company and demand of the company, each part today is available for 200 rupees. So one partnership bond. Here I took an example of 1 lakh one partnership bond, 5% partnership, but in stock market it doesn't work like that. This was just for our understanding. How it works is the percentage of one share is 0.00001 or something like that. So you will get it at a very minute price. This is so that anybody can invest. If I keep a one share of 1 lakh each, 1 lakh each, not everybody will be able to buy it. So this is done so that everybody can afford. There are a lot of buyers who come, who buy the stocks, and then the company grows, the price of the stock also keeps growing. So this is how exactly the mechanism works. When first time these companies are launched, they are launched in the form of IPO, initial public offering, and that is when the the company gets the money. Okay, after that, this shares come on the secondary markets, and those secondary markets are known as your stock exchanges. So this shares of this companies are available on the secondary markets, that is your major stock exchanges. And the major stock exchanges in India are the NSE and the BSE. There are many other, but for the equity trading, these are the major stock exchanges: National Stock Exchange of India and Bombay Stock Exchange. So let's gain some knowledge about National Stock Exchange. The National Stock Exchange of India is the leading stock exchange of India, located in Mumbai. The NSE was established in 1992, the first dematerialized electronic exchange in the country, which means this was the first stock exchange where whatever electronic trading you're doing through your mobiles and your laptops, computers, through the internet, was first started in the NSE. Before that, you had the paper trading, where you had to trade the shares in physical bonds, right? But today you can do it electronically. The market capital is USD 2.27 trillion. So when I say the market capital of NSE, see, as I gave you an earlier example, I told you that if you sell off the company into the market with everything it owns, whatever price you are getting is known as the market capital. So does the same logic I can explain this? No, I cannot explain that with the same logic here. If I say, if you sell off this NSE building that you can see in the image and you're getting this amount, 2.27 trillion USD, no, that's totally wrong, right? So in simple words, I'll tell you, okay, you have totally 1,952 companies on the NSE. On the National Stock Exchange, you have 1,952 companies. So you can buy and sell shares of 1,952 companies. Now the combined value of the shares listed on NSE, that is 1,952, the combined value would be 2.27 trillion. This stock exchange is located in Mumbai, India, right? And it was founded in 1992. Coming to the other one, that is the Bombay Stock Exchange. It was founded in the year 1875, again in Mumbai. The number of companies you have on this stock exchange is 5,439 companies. So you can buy and sell shares of 5,439 companies. Majority of the good companies are on both the stock exchanges. A company can have its shares only on NSE, a company can have its shares only on BSE, or the company can get listed on both the stock exchanges. In a layman's language, let's say I'm a farmer and I have potatoes, tons of potatoes this time. Okay, So now what would I do? Would I just put up all the potatoes on one city market and wait for them to get sold off? Or I can just put it up on two different markets. Now there's a different procedure to do it in the stock market. You have to go through all the rules, regulations. So that's secondly, I'm just trying to explain that with simple layman's language. So let's say I have potatoes and there are two markets called NSE, BSE. So what I'll do, I'll put up this potatoes on both the markets. Let's say I'm putting up 70, 30, 50, 50, whatever it is. So I put up the potatoes on both the markets so that they get sold off fast and they get sold off easily. And I get the money soon. So a company can decide whether to get itself listed only on NSE, only on BSE, or on both. Obviously, each stock exchange has its own criteria that the particular company has to satisfy. Only then it can get listed on both the stock exchanges. So you have a lot of companies which are available on both or which are just available on one. Now, where in practical trading, where do I come into contact with this NSE and BSE? Let me tell you, whichever trading platform you have. For example, I have the Zero the Kites trading platform. Okay, so when I go to this trading platform, okay, now what is this trading platform? If anybody wants, we have a very beautiful video on this trading platform, how to use it from the very beginning till the end. We have a very nice video on this. You guys can watch the video. That video will help you understand everything that I'm doing right now. Right, what is this, how to add stocks, how to observe stocks, how to buy stocks, sell stocks. If you just want to learn, watch our video on Zero the Kite. We have a very beautiful video on that. Now when I come to this, let's say I want to buy a particular stock of a particular company. Let me just clear my list. Okay, so let's say I want to buy a stock called Titan. So when I type Titan, you can see Titan NSC and Titan BSC is what appears. So if I want to buy the stock in NSC, I will select NSC and add it to my list. Now Titan NSC is added to my list. So if I buy the stock, it will be bought under NSC. But if I want to buy it in BSC, so I'll just type Titan and I will select BSC. So in whichever stock exchange I want to buy it, I will select that particular stock exchange and buy. Now, if you see, the price difference is also not major price difference. Okay, a minor price difference based on the two markets. So let's say in the city central market, you are getting prices for a little higher price, potatoes for a little higher price, and the same potatoes are being sold at a outskirt market for lower prices, or vice versa. So minor difference, but there cannot be a major difference, right? If the potatoes are 10 or 20 rupees kg in one market, it cannot be 100 rupees kg in another market. It might be 21, 22. So minor differences in stock market, in stock prices in both the exchanges. There are various factors that based on which we decide whether we want to trade in NSE and BSE. There's something called volumes. Okay, so in NSE, if you see the today's volume, this is NSE, today's volume was 76 lakhs 46,653. If I go to BSE, today's volume was 2,85,000. So difference in volume. Now if you want to know what is volume, again you have to watch our video on market depth, which is a completely different video, and again this is very well explained. Everything that you see here, the bid, the orders, the quantity, and the offer, the orders, the quantity, the open, low, volume, every terminology that you have over here has been completely explained in detail in that particular video. So I would request you to observe that video. So as you can see, trading volumes are very high in NSE. So a lot of people prefer trading in NSE, right? So this is exactly how the markets work, right? So you have NSE and BSE. Now, as I told you, there are 1,952 companies in the NSE and there are 5,439 companies in the BSE. But you guys might have heard the terms that the market is doing positive today or the market is doing negative today. So how do these terms come into picture? How do these terms comes into picture? How does one know whether the markets are doing positive or whether the markets are doing negative? To understand this, there is something called index. Okay, and the major index for NSE is Nifty 50 and the major index for BSE is Sensex. So what is the major index? Now let us see. What is this Nifty 50 and Sensex? Because as soon as I go to my trading platform also, you can just see over here, you can see over here that I have Nifty 50 and Sensex, which I can see is negative today, minus 1.64, minus 1.77%, right? So you have negative Nifty, you have negative Sensex. Okay, so what does this values represent? What is this 10,891 and what does minus 1.64 means? And from where are we deriving this value, 10,891? Is this a company or what is it? So that is what we meant when we say index. So let's understand the index and how this index basically works. So when I go to Nifty 50, let me try to understand what is Nifty 50. Guys, how many companies are there in the stock market totally? Totally, I told you on NSE, you have approximately 1952 companies, 1950. So I'll just assume that 2000 companies. 2000 companies is what you have on NSE, correct? Now, let's say I want to decide today morning whether NSE is positive or negative, whether this market, that is NSE, the stock exchange, is doing positive or it is doing negative. So this is what I want to decide. So when I say I want to decide whether NSE is positive or negative, now how can I decide that? Okay, simple logic. I'll check all the 2000 companies, whether they are positive or negative. So let's say I will go to company number 1 and check whether it's positive or negative. I'll go to company number 2 and check whether it's positive and negative, so on. So let's say if out of 2000, 1100 companies are doing positive, the stock prices of this 1100 companies are going up today, then I will say markets positive. But assume that stock prices of 1100 companies are going down today. So if the stock prices of 1100 companies, that's more than 50%, are going down today, I will say markets negative. But my question is this technically possible? Let's try to understand whether it's technically possible. I'll go to company number A and A positive. I'll go to B, that's also positive. And I'm moving on. I'm going to C, positive. I'll go to D, okay, negative. And I'll go to E, which is positive. Now, by the time I check F, what will happen to A? Which was positive turns negative, B which was positive turns negative, C which was positive remains positive, D which was negative turns positive, and so on. Because every moment, every second, stock prices are fluctuating. So for a human observing 2000 stocks and deciding 11,000 are positive and 900 are negative is technically impossible. So this method is not going to work out for me. So what I do, I try to simplify the mechanism. What I do is, out of this 2000 companies, I will select top or best 50 companies based on their market value, that is the giant companies, based on their past performance in the previous years, okay, and many other factors. I select the top 50 companies and I tell you, these are the elephants of the stock market. If they go up, they will pull the market up. If they go down, they will pull the market down. So let's not concentrate on all the 2000 companies. If you want to decide whether the markets are doing positive or negative, I will give you a simple method. Just focus on this 50 companies, and out of 50, let's say, just an assumption, out of 50, let's say if 30 are doing positive, then we will say markets are positive. Let's say out of 30, if out of 50, if 30 are doing negative, we will say markets are negative, right? So this is what we believe. I mean, this is how it works, mechanism, right? But again, observing 50 stocks is quite difficult. So what I do, Okay, I take an average of this 50 companies. Okay, so now the average is not taken, it's not a sum average, it is a weightage average. For example, what I mean is you don't add up prices of all 50 companies and divided it by 50 like how we do it. So let's say the top company in the Indian stock market is Reliance. You'll have TCS, let's say, you have HDFC, okay, and so on. So you have these companies. Each company is given some points based on their market capital, based on their weightage. So out of the Nifty 50 value, each stock will have certain value. For example, let me tell you, Reliance has a value of 10% in Nifty approximately. Okay, so based on this weightage, how it is done, you don't have to get into so deep details about it, but I'm just giving you an idea. You just need to understand that it is a weightage index of top 50 companies. So what is Nifty 50? Nifty 50 is the weightage index of the top 50 companies. So each company is given some points, and when you add up all those points, you get the value of Nifty, that is 11,194, recorded on 24th July. It keeps varying every day. So today, if I see Nifty, what's the value for Nifty today? 10,891. So as you can see, from the day we have created the presentation to the live date, there's a major difference in it. This value that you see, it is in terms of rupees. Now, if those 50 companies do not perform well, Nifty will be negative. And if those 50 companies perform very well, Nifty will be positive. Remember, Nifty 50 is the index for NSE. It represents what NSE is doing. If it is positive, it means NSE is positive. If it is negative, it means NSE is negative. NSE is the major stock exchange. You say Indian market is positive or negative looking at Nifty and Sensex. Sensex is index for BSE and the index of top 30 companies on BSE. So today, as we could see, NSE and BSE both are doing negative. Now, what is a normal range for this? Because I can see 1.64% negative. What does this mean? Or 1.77% negative. What does this mean? Let us just concentrate on Nifty as of now. But let's say 0 is the point, 0 point. Okay. Now above 0, it would be 0.1%. Correct. It would go up to 0.2%. Okay, and so on. And when it's going negative, it might start going something like minus 0.1%, correct, or minus 0.2%, minus 0.6%, or even minus 1.00%, and so on. Now, if you see today, Nifty is well beyond -1. It's minus 1.64, gone down even further. Okay. So when I say that, we consider this value, that is 0.6 positive to 0.6 negative, as a normal range. So if the stock is moving between this range, that is Nifty is moving between this range. Okay. So we say it's normal movement. Anything above this, we say good rise, good rally. Okay, good upward movement. And anything below this, we say good fall and good negative movement, right? That's how we decided. But then again, a lot of people consider +1 to -1 as normal. So based on the type of analysis that you're performing, you get to decide it. But -1.64, anybody would tell you it's a good fall. -1 to +1, you can consider normal range as a beginner to understand the markets. But in our strategy, this is 0.6 to 0.6. So that is your Nifty 50 and that is your Sensex. Now, moving on, like you have stock exchanges in India, guys, like that is your NSE and your BSE. You also have stock exchanges around the world. USA has its own stock markets. London has its own stock markets. Like India has its own stock markets. Okay. So you have, for example, the US markets, the Nasdaq. As you can see in the image, Nasdaq is negative 0.94. Also on 24th July, the US markets were doing negative The London markets, FTSE, negative. The German markets, negative. Okay, SGX Nifty, the Singapore markets, negative. SGX Nifty is the index of the Indian companies traded on Singapore Stock Exchange. So a lot of people observe this. There's a different understanding to it, how it impacts our Indian markets. So these are global stock exchanges. Now the question comes up, why are we talking about global stock exchanges? First of all, let me tell you where you can observe them. You can observe them on Money Control, CNBC, or Stock Edge app. There are different apps which will help you understand how these markets are doing. They will show you the data, so you can download those apps, see which is user friendly for you. Very good apps. Okay, we thank the creators of those apps so that we are getting the data easily. So now the question comes up, why are we talking about this stock exchanges or this stock markets? Let me tell you one thing. This stock markets are cousins. What is he talking about? What cousins? How does cousins come into stock market? I told you it's a layman's guide to stock market, the basics of stock market. So everything I'll just explain to you in simple manner so that it fits into your mind. Let's say there are siblings, okay, and these siblings are NSE and BSE, okay. And the cousins, among the cousins, you have the first cousins. So let's say Asian markets are first cousins to the Indian markets. Then you have the second cousins. European markets are the second cousins for the Indian markets. And there is also, okay, the head of the families, that is the grandparents. So you can consider the US markets as the grandparents of this family. Okay, US markets. In USA also you have two stock exchanges, that is the NYSE and the Nasdaq. You can read about them. Index for USA, that is Dow Jones. Read about it, very important. Okay, so let's say these are siblings, NSE, BSE. Asian markets are first cousins to them. European markets are second cousins to them. And then you have grandparents, that is the US markets, right? So now when I say that, how is the impact on them? See, these guys are related to each other, but logically speaking, the life is not the same. Let's say in one cousin's house, okay, so we have different houses for the different cousins. Okay, India is the house for NSE, BSE, then you have Asian markets, then you have European markets, and then the US markets is what you have. So let's assume today at one cousin's house there is biryani. Not necessary in the other cousin's house you might have biryani. One cousin, they might be eating dal chawal, and the third cousin is eating something XYZ. Okay, what I'm trying to say is, though they are related, their life is not same. Let's say these guys are going out for a party today. Not compulsory these guys will go out for a party. They might be going out for a movie today, these cousins. Okay, or let's say these guys are just relaxing at home, so their lives are not the same. But let's say there is such a bad news that would impact the entire family. Okay, now all the cousins join in sorrow and in grief. Let's say there's a good news, again all the cousins join in to celebrate. So you can see they are related to each other. Normally they have their own lives, but in terms of situations which are very bad, everybody joins in. And in terms of situations of which are very good, everybody joins in to celebrate. So why I'm giving you this example is, for example, let's say the US markets today are -1% negative. This won't have major impact on India because this can be minus, this can be plus. Okay, they can be doing whatever they want to, right? Let's say the London Stock Exchange is also -1% negative or -0.4% negative. So this is the daily routine. Tomorrow your Indian markets might end up positive. So each one based on what is happening in their country, how their economy is working, what good news, bad news they have on a particular day for particular sectors. So there will be movement. But imagine on a particular day, you see that the US markets are down beyond the normal limits. So let's say they are down 3%, okay, or they are down 4%. Now what happens over here is This creates a global negative impact on the minds of the investor, which in turn will result in a negative opening for the Indian markets. By the time you wake up in the morning, the European markets are already closed, the US markets are already closed. You will get to know how the global markets is impacting. So you just go to Google, nothing, you just type global markets. This is what you see. So now I can see Nasdaq. You can see the watch. That means it's currently on, and the Nasdaq is 1.36% plus. Oh, good positivity here. Okay, I go to the European markets. The European markets have already closed. They start approximately 2:15 Indian timing. London Stock Exchange has closed 2.2% positive. Then this one has closed 1.93. Germany has closed 2.71. Very good positivity. And now SGX Nifty showing small positivity, but it's currently on. You'll get to know the data in the morning. You have some of them are doing negative, but I can see a positive impact on the global markets. So I get an idea that, okay, tomorrow morning, maybe the Indian markets will have a positive impact. Not necessarily, let's say there's some bad news coming in for India, then the Indian markets also will be negative. This is how we understand the global markets. As I told you, they are cousins to each other, right? Hope that's clear. Okay, so that is what our city is, equity. So what we just did is, out of the various segments that we have, that is equities, derivatives, commodities, etc., we have selected the equity segment. We know what equity segment is, how this partnership bonds are created, and then we also know where they are available. They are available on the NSE and they are available on the BSE. We have seen in detail about NSE and BSE. Okay, we know what is Nifty 50. It is the index for NSE. It's the weightage average of top 50 companies. BSE is the Sensex. Index is Sensex. It is the average of top 30 companies. Okay, we know how the global markets impact the Indian markets as well. Okay, the cousin relationship, as I told you, the family relationship, right? And you can download these apps and see which is user friendly for you. So you can use any of these apps, right? So that is all in selection of city. That is, our segment is equity segment. So now I have selected my city. My city is equity. I will invest in the equity stocks. Now in the equity stocks, the question comes up, which area should I select? That is your sector. As I told you about the sector, there are various sectors in the stock market, and these sectors are basically your IT sector. This are IT stocks. And then you have the pharma sector, that is your pharmaceutical stocks. Then you have your industrial sector. These are your industrial stocks. Okay. FMCG sector, your fast moving consumer goods, your soaps, shampoos, etc. Okay. Pharma is the one that manufactures medicines. So there are different category of stocks under the selection of sectors. So you have various sectors and you have various stocks under those categories. If I say banking sector, there are so many banks. If I say industrial, so many industries. Pharma, there are so many pharma sectors. So first of all, on which day, what sector should I target? Now, how would I know today? Okay, I will concentrate more on IT stocks. There's a good news for IT stocks. Let's say there's a good news for IT stocks. So how are the IT stocks behaving? Are they actually going up? Are they actually going down? How is their performance? Are the pharma stocks doing well? So how do I get to know this? There's a very simple mechanism, guys. Okay, and that is, selection of sector is done based on the minor indexes. What is minor indexes? I'll tell you. The minor indexes for NSE I'm considering. You have Nifty IT, Nifty Bank, Nifty Energy, Nifty Pharma, Nifty Auto, etc. What does this mean is, like Nifty 50 I told you is the average of top 50 companies on NSE. So it represents all top 50. This top 50 will include all companies, pharma, industrial. So based on that, you will have it. Okay, based on the ranking. Okay, irrespective of the sector. But when I say Nifty IT, it is the average of only IT companies. And this will show you how the IT companies are behaving. If I show you Nifty Bank is specifically the average of index for banking sector. So this will represent what banks are doing today. If I say Nifty Energy, this is specifically index for energy stocks, and it will represent what energy sector is doing today. If I say Nifty Pharma, it specifically represents what pharmaceutical stocks are doing today, and so on, right? So where do I get to know this? Again, that's a simple mechanism. You just go to your trading platform. Let me just go to my trading platform, and here in my trading platform I have the Nifty 50 and Sensex over here. Now I can add, like for example, Nifty IT. Here it is, indices, Nifty IT, Nifty commodities. Okay, and I can add Nifty Pharma. Okay, that's your pharma. I can add Nifty Auto, Nifty Energy. So now let me see this Nifties. These are different Nifties particularly. So today you can see market is 1.64 down. Okay, Nifty 50 is major indexes down, but Nifty IT is very slightly down, was 0.59%. Nifty Pharma is even less, just 0.18%. So even though markets were down, the Nifty Pharma did not take much hit. Okay, Nifty banks were the ones that dragged the market very low today. Banking sector has been pulling the stocks down today. The entire market's down today, 2.62%. Nifty Energy also has been pulling the stocks down today. So you get an idea. Now in further trainings, when we learn the analysis, first thing we will analyze is this. For example, let me just go with a technical analysis. We don't perform technical analysis or fundamental analysis, not the conventional one. We do the chart analysis, but we have a totally different approach to it. But let me go with a conventional method and tell you, okay, for example, the banking stocks. So let me click on the banking stocks. I can see the banking stocks has reached this particular level today, 21072. How to read the candles? We have a all totally different session on this. So when I say candle chart, you can see this green color means that particular day the stock went up, and the other red color means the stock is coming down. So now it's at support level. Okay. So if anybody knows what support and resistance is, if you don't know, you can just watch some YouTube videos on this. We also are coming up with a video soon on that, so you might see that as well. So here you have the support level. So now for tomorrow I will be focused on Nifty Bank. Example, I'm not saying we'll really do that. Okay, I'm just giving an example. So here Nifty Bank is on the support level. Okay, so if it is on the support level, technical analysts, they assume that the stock will go up from here. Nifty Bank will go up here from here. It means the banking stocks will go up from here. So technical analysts will start targeting banking stocks tomorrow. If there's fundamental analysts, they have some good news about auto sector, so they'll check Nifty Auto and they will target auto sector. So it depends on individuals, but this gives you a clear picture on which sector you should be targeting for a particular day or a particular week or for the next particular month based on whatever analysis you have done. Perform your analysis on this indices rather than individually analyzing the stocks. And once you are done, okay, let's say I will be targeting the Nifty Pharma because it's been going up very nicely for past few days. So I'll target Nifty Pharma. So let's say if I've decided that, then I can go to specific stocks and target them. So this makes my work very, very simple. So if we want to decide which stocks to target, which sector, selection of sector, we do it based on the minor indices for the day. So you can read about the minor indices. You can just understand how this minor indices works. So now let's say, assumption, Nifty Pharma is doing well. Okay, so I will assume that I am going to invest my money into pharmaceutical stocks. So in the equity city, I have selected the pharma area. Now in this pharma area, there will be a lot of apartments, that is a lot of individual companies. Like for example, you will have companies under the pharma like Cipla, Sun Pharma, Granules, Glenmark, Divis Lab, so many pharmaceutical companies. Now, which pharmaceutical company should I select, and in which pharmaceutical company should I invest my money into? is what we will be seeing next. See, there are various categories of companies, various what do you say, criterias based on which you can decide in which company you should be investing your money, which stocks you should be picking, how many stocks you should be buying, and those are all different things. But what is one major criteria? I can give you a simple way to go forward with it for a beginner to pick up companies, so he's on the safer side. So selection of best companies. Before I go to selection of best companies, I want you guys to do just the imagination. And what is that imagination that I want you to do? Imagine you have an amount of 1 crore rupees. I give you 1 CR. Let's imagine how happy you are. Very, very happy. Big amount, right? Now imagine that I'm giving you 10 CR. How happy are you? Extremely happy. You cannot imagine your happiness right now, because 10 CR is a big amount, very big amount. If 1 CR is big, 10 CR is very big. Let's imagine I'm giving you 100 CR, guys. Okay. So when I'm giving you 100 CR, this is not big. This is not very big. This is gigantic amount, isn't it? Now imagine I'm giving you 1,000 CR. It's not big. It's not very big. It's not gigantic. It's enormous. 1,000 CR. Now imagine a company worth 1,000 CR, how big that company would be. Just imagine a company worth 1,000 crores. How big, how gigantic, how enormous that company would be. Correct? Let me tell you something. What you're considering as a gigantic company in the stock market, this company is termed as micro cap. The stock market says, dude, you're so small that I need a microscope to see you. So you are termed as micro cap. Any company, you know why I made you do that imagination? I could have just said 1,000 crores is this, 10,000 crores is this, and so on. But what would have happened? You would have not realized what numbers we are talking about. So not 1, not 10, not 100, but 1,000 crores company is termed as micro cap company. 1,000 crores to 10,000 crores is termed as small cap company, which means if the value of the company is 1,000 crore to 10,000 crore, it is termed as small capital company, market value company. Or 10,000 crores to 50,000 crores is termed as mid cap company, medium. Okay, above 50,000 crores it is termed as large cap companies, and above 1 lakh crore it is termed as the largest cap companies, above 1 lakh crore. Now these companies above 50,000 crores are called blue chip companies, blue chip stocks. Now how do you remember this? A simple example: if you go to a casino, you have to give the cash and you have to buy those plastic chips. So the costliest chip among them is the blue one. So when you see the blue one, you know that is the costliest chip. Similarly, these are blue chip stocks. So you know these are really costly companies or really big stocks. Really big stocks. So a blue chip stock is a stock of a large, well-established and financially sound company that has been operated for many years. A blue chip stock has typically a market capitalization in billions, is generally the market leader or among the top 3 companies in its particular sector. Okay. Now, for example, Reliance Industries. That company is 10 lakh crores plus. Not 1 crore, not 10 crore, not 1,000 crore, not 10,000 crore, not 1 lakh crore, it's 10 lakh crores plus. Wipro approximately 2 lakh crores, TCS around 8 lakh crores. So you have different companies like this. These are big giants, you know. Even if the markets go down, the economy of the country goes down, but in slope, these companies have the reserves, they have the power, they have the profits, they have the properties, they have the revenue, they have everything to stand strong. They might go down, but they have the capacity to bounce back. But on the other hand, you have penny stocks, stocks which are traded at very less values, whose market value is very less. These stocks are very illiquid stocks. Sometimes you buy them and you will not be able to sell them. So there are many issues involved with the stocks. But again, they are very attractive to the beginners. The beginners feel, oh, it's a small stock, I can make money out of it. No, not necessarily. You might lose a lot of money in this and you might make money in this, because stock market is a game of percentages. So whether you get 10% from here or you get 10% from there, it's one and the same. But yes, it's pretty obvious that the stocks have chances of multiplying very soon. Okay, so now what happens? This attracts people. But let me tell you one thing. There's one risk involved with this penny stocks. That is the pump and the dump mechanism. Guys, every beginner, please pay very close attention to this slide, because we have seen a lot of people lose heavy money because of this. So be very, very careful and pay very, very close attention to this. There are some stocks, and the stocks are like moving in some small ranges, like 4 rupees to 6 rupees and back to 4 rupees. So it's moving slowly up down, 2 rupees, 3 rupees, 4 rupees, 5 rupees, 6, back to 4, back to 2, and it's moving in like a normal stock. All of a sudden, what happens on a particular day, you see that the stock suddenly starts rallying and rallying to a very good price, sudden rise in the stock. Now, this rise is basically because of a heavy buying at the lower price by some XYZ investors who are sitting out there to make huge money. Okay, so what they do is they buy the stocks, and now the stocks are pumped up. Now, when the stocks prices are pumped up, the person who bought it here are into very, very heavy profits. And when they are into heavy profits, they want to sell the stock and get out of the stock. But since the stocks are so unpopular, not many of them know it, they will not get many buyers over here. So they can sell only when new buyers come in and wish to buy the stock. Okay, so they can sell at this price only when new buyers come in and they wish to buy the stock at this price. So buyers should come in here and they should be like, give me, I want to buy. So what they do to attract buyers, okay, people like you and me might receive messages from unknown sources that, hey, look at this stock, it has rallied from 4 to 14, it's an amazing stock, it will go to 140, it will go to 200, 300. Now people like you and me with no or very little knowledge about the stock market, we just go and open the stock chart and we see that actually the stock has rallied amazingly in past few days. We get excited and we buy the stock over here. And once we get buy the stock, right, the unethical traders get a chance to exit the stock. And now what happens is they sell off and they exit in profits while the stock suddenly gets dumped and you lose a heavy part of your investment. When the stock gets dumped, sometime it gets dumped into the lower circuit as well and continues into the lower circuit. So even if somebody has bought it over here, they will not be able to sell it. Right. So what is lower circuit and upper circuit? There's something called upper circuit and lower circuit. For example, you can see over here, this stock called XYZ, a Birla tire stock, has hit the upper circuit. When I say it has hit the upper circuit, it means there are no sellers. So if you wish to buy the stock, you cannot buy the stock because nobody is selling it. This is called depth of market. As I told you, we have a video on this. If you watch that video, you will understand this in complete details. What is upper circuit, what is lower circuit I'm talking about. So when the stock hits the upper circuit value, there will be no sellers, the zero sellers, nobody is selling it. So if you wish to buy, you will not be able to buy it. And look at the other hand, this stock called Rain Industries, it has lower circuit value. So when it hits the lower circuit value, it means if you're trying to sell, you will not be able to sell it because there are no buyers, zero buyers, nobody is willing to buy. Okay, so you'll not be able to sell it. So sometimes it gets dumped so badly and you're trying to sell every day, but you will not be able to sell the stock at all till it goes very low and you lose your money completely. You'll not be able to sell because there's nobody willing to buy the stock. So this pump and dump mechanism is very, very bad for people like you and me, and we should be very, very careful about it. We should be very, very careful about it, right? So first thing you can avoid this is by not following tips messages from unknown numbers. In fact, don't follow tips messages at all. Do your own analysis, learn it. It's not a rocket mechanism. See, today I think most of the part you're learning might be new to you, but when we have put it up in a systematic order, it becomes so easy, right? So majority at TalkTech, what we advise our students is majority of the money should be invested in the blue chip companies. I'm not saying don't invest in this. This give you a good opportunity to multiply your funds soon. Okay, but there is risk also involved, right? So basically, I'll tell you my personal way of doing it. My 60 to 70% money is into the blue chips. Blue chips. I will invest 10% of my capital here, 10% of my capital over here, 10% maybe over here. But majority of my funds, if I'm having a bigger fund, then again I'll reduce it. I'll invest 80% over here, and then maybe 10% over here, 5% over here, 5% over here. So depending on what kind of funds we have, okay, we can take a decision to invest. But again, majority of the blue chip companies, see, these companies are called blue chips because they are financially sound. They have operated for many years. So there's not just shell some fake companies that's come into the market right now. So obviously these are stable companies. They have reached these values because they are strong, right? So we tend to invest majority of the funds in these companies and very small amount of funds into this particular companies. This is how we particularly trade, right? So that is the selection of the company. So let's say, okay, in equity segment, I go to pharma sector, and in pharma sector, let's say I selected Cipla. Why did I select Cipla? Okay, just let me go over here. So I've selected the pharmaceutical sector. Okay, so in pharma, let me put up some companies. Just let me clear off my list. Okay, so I'll just put up some companies. Let me put up Cipla, Divis Lab, Sun Pharma, Glenmark, Vok Pharma. So you have so many pharma stocks. Now, simple way. Okay, I'll just start with Vok Pharma. I'll go to more, and here you have fundamentals. I just click on the fundamentals. I'm getting the market capital. Market capital is 3,361 crores. So when I say 3,361 crores, okay, that fits in into 3,000. Okay, it fits into a small cap. So we know Vok Pharma is a small cap. So if I have to invest money into it, I'll invest small amount into it. Okay, right? Okay, now let me just check out granulase. I'll just go to more and fundamentals, and I can see 7,000 crores. So I can see again it comes under the small cap itself. Okay, I'll go to Divis Lab and let me go to fundamentals, and that's a 70,000 crore worth company. So a blue chip, anything above 50,000 crores is blue chip, and this is 70,000 crores. Let me check out Sun Pharma fundamentals, and that is 1,24,000 crores. Big, huge. Okay, 1,24,621 crores. So above 50,000 crores. Again, a blue chip. Cipla, let me just check that out. 57,000 crores. Again, a blue chip. So I know this top three that I've selected are blue chip. This two are small cap. Glenmark is a mid cap. And among the blue chip, again, you have Sun Pharma, which is the ultra blue chip, that is 1 lakh crore. So if I now put them up in the order of market capital, Sun Pharma tops the order, then Divis with 70,000 crores, 55,000 crores, then Glen with 12,000 crores, and 6,000 crores, and 3,000 crores, so on. So based on this, I will target the blue chips on unstable markets because the blue chips are safer for my investment. But if you are doing trading is completely based on levels. Okay, so if I have to trade Vok Pharma, I'll trade it with level, Sun Pharma with level, etc. Okay, so this is how you can just watch the market capital of the companies and be on the safer side. So that is three steps that you have. That is selection of city. Our city is the equity city. Selection of area. Our area is pharma area. Then you have the selection of apartment. That is selection of the company, and we have selected Cipla company. So under the equity segment, we have selected pharma area and we have selected the Cipla company. Now when I have selected Cipla to trade, now the question comes up. Cipla is currently, as you can see, at 710 rupees. So should I buy it immediately over here at 710 rupees, or should I wait for the stock to come down and then buy it, or should I wait for the stock to go up, stock price to go up and then buy it? That is what we call the last and the final step. That is the selection of the floor and flat. Okay, that is your selection of levels. At what price should I be buying Cipla? So now we will see the selection of levels. How do we decide this levels? At what price do we have to buy? What price do we have to sell? So when I say levels, there are three very important levels in stocks. The level number one, that is the most important level, is the entry line. At what price should I buy a stock? So for example, in the stock chart, we can see the stock is at 71 rupees. So if I'm buying the stock at 71 rupees, that is called my entry line. So the first and the most important value is the buy level. And now if the stock is going up, at what price should I sell the stock? That is called my target level. And if the stock by chance, instead of going up, starts going down, then where do I cut off my losses? That is called the stop loss level. So let's understand these levels a bit in detail. Okay, so every stock, when people buy stock, we buy it with an expectation that this stock can give me profits. So let's assume there's a stock at 100 rupees and I am planning to buy the stock. My expectation out of the stock, if I buy it here, that the prices of the stock would go up. But it is not compulsory that the stock prices might go up after I buy. A lot of people tell you that there are strategies, there are accuracies. If you find out, you'll know for sure. Okay, let me tell you one thing. Stock market doesn't work on surety. Stock market only works on one term, that is probability. Probability. Everything is a probability in the stock market. There's no surety in the stock market. Any analysis you do, any mechanism you apply, it's all about a probability. So when I buy a stock, even I analyze and I pick a stock. So the probability from my analysis, the stock going up is high. So I buy the stock. But again, as I told you, it's not sure that the stock will go up. In fact, instead of going up, the stock can start going down as well. Okay, so now if it starts going up after I buy it, that is my profits. And if it starts going down, that is my losses. Now, a person who's trading into the stock market should be very well aware about the profits and how to minimize the losses as well. So let's say when I have bought the stock at 100 rupees over here, okay, assume scenario number one where the stock starts moving up and the stock is going up and up and up, and I'm into very good profit. The stock moves 100, 104, 105, 110, but I don't know when to sell the stock and where to sell the stock. And the stock all of a sudden starts reversing down and comes back to the original price. And what happens over here is I lost all my gains. Okay, all my gains. Now assume scenario number two. As soon as I buy the stock starts going down. Now I have bought the stock at 100. This stock can go down to 90, 80, 70, 60, anywhere. So if a person just blindly holds onto a stock, he might end up making big losses. So to avoid this big losses, there is something called stop loss in the market. Guys, I'll give you a simple example. Okay, what is stop loss? Stop loss is like the life jacket. If you don't have it, there are very high chances that you're going to drown. So a stop loss is something that helps you minimize your losses. So for example, let's say I have bought the stock at 100 and I set a stop loss of 96, which means I am setting an automated order into the system where if the stock comes down to 96, it will be automatically sold off. So you don't have to be in front of the system live, you don't have to watch. Okay, so it's a level, below which I'm not letting my stock go. Stock will obviously go below this, but I am getting out of the trade here. So I am ready to take a 4 rupees loss in this particular trade. So if I'm trading the stock, I'm ready to take a 4 rupees loss. So you should know exact level where to cut off your losses. Now, sometimes what happens, people are fearful. What they are fearful about is, now if I buy a stock, let's say I buy a stock at a XYZ price, or this is my stop loss, let's say this is my buying price. Okay, I've bought the stock here and I've kept a particular stop loss. Now people are scared. They think that, okay, the stock might go up and then come down, hit my stop loss and then again go up. So if I keep a stop loss, the stock will get sold off and then my stock might rally and I will be out of the trade in loss, whereas the stock rallied. No. Yeah, that can happen in the stock market, but again, you should have a good strategy, a perfect strategy to trade, where if the stock by chance reaches your stop loss level, this level, okay, is such a level beyond which the stock goes down, okay, and doesn't rally up. Because you should have the perfect mechanism, you should try to identify which are the weaker points of the stock and at the weaker point, because beyond this point the stock is going to get weak and it's going to fall down. Okay, so at such levels, like for example, till the strong levels you don't put a stop loss, and just below the strong levels, when the weaker levels start, you have a stop loss. So what happens, before entering the weaker levels, you are out of the trade here, you are saved, then the stock falls, it doesn't matter. So that is why the stop loss is a very, very important concept in the stock market. So first most important part here is buy level, where to buy the stock. And once you buy, the next most important is where you should put a stop loss, that is where you should cut your losses. And the third most important is where you should have your targets. Target is if the stock starts going in your direction, right? You buy it and you're going up and it starts moving up, right? So at what particular price you should sell in profits. So that's called target, sell in profits. Okay, so basically this is your buy. Stop loss is sell in loss, because when it's going down, you're trying to sell with minimum loss and avoid the big losses here. So basically you're avoiding the big losses that could have further happened by cutting off the trade over here. You're avoiding this losses, correct? You're out of the trade over here. Now even if the stock goes, it won't damage you because you have sold it and out. Whereas targets is basically sell in profits. Okay, targets is basically sell in profits, because let's imagine, as I told you, a stock keeps moving up and up and up, and now you don't know where to sell off the stock. And what happens, from a certain level, let's say you don't know where the target is and the stock is moving and you are holding on to it, and after a certain level the stock reverses, comes down and hit your stop loss. You were into profits, but now you ended up making losses. So you should also know when the stock is going up, at what price you should sell the stock, and you should be out of the trades. So the most important levels in the stock market when you trade are basically your buy, your stop loss, and your target levels. Target levels, right? So any analysis that is performed in the stock market is performed for these three values. Where should I buy the stock? If it goes against me, where should I put the stop loss? And if it starts going into my favor, where should be my target? So all the analysis that you have, every analysis that you do are just performed for this level: buy level, stop loss level, target level, and how long can I keep that stock. That is your investment period. Okay, now finding out this levels is done based on various types of analysis. How to do that? You have fundamental analysis, you have technical analysis, you have psychological analysis, you have the demand and supply analysis. So what are this analysis basically? What is fundamental analysis? What is technical analysis? What is psychological analysis? And what is your demand and supply analysis? So let's just see them one by one. Fundamental analysis, in brief, let me tell you. Fundamental analysis, okay, when I say this, this is in simple words study of the company. So when I say study of the company, it means how stocks are how the company is performing, what is the past result of this company, okay, how it has been doing for last 5 years, or how this company has been doing for last 10 years. Okay, what is the current profits of the company, how is the company working, what are their future plans. So study of the company is called fundamental analysis. So for example, let's take Reliance Industries. So I will study now what is Reliance Industries doing, how it is working, okay, what products are it's producing, how much is it profit is it making, and all these things I will be looking under fundamental analysis. Balance sheet of the company, the different ratios, the P ratio, the inventory ratios, and there are so many other things. In-depth study of the company's performance is called fundamental analysis. On the other hand, you have technical analysis. Okay, you have the technical analysis, and technical analysis is nothing but analysis of stock charts. So when in fundamental analysis, you're looking at what the company is doing, you're looking at what Reliance Industries is doing, but when it comes to fundamental analysis, technical analysis, you're not looking at what Reliance Industries is doing. In fact, you are looking at the stock chart of Reliance Industries. You'll not look at what the company is doing. Okay, as I told you here, the product and how they are selling, how much is their profit, all those things. No, in technical analysis, you're not looking at all this. In technical analysis, you're just looking at the stock chart of the company, how the stock chart is moving, what is the current level of the stock chart, where it was yesterday, where it is today, and all this. Okay, in this you have levels called support levels, you have levels called resistance levels, okay, you have trends, and there are so many other analyses that are performed on the stocks. At StockTech, we don't exactly perform the conventional support, resistance, or we do not even use any indicators, oscillators. Though we do technical analysis, we do the chart based analysis, but it's something beyond conventional analysis. Okay, let me come to that later on. So this is your fundamental analysis, study of the company, what Reliance is doing. And technical analysis is what stock chart of Reliance is doing. Okay, so this is the difference between fundamental and technical. Now coming to the other study, that is the psychological analysis. This is a very interesting one. When I say psychological analysis, it's about people's mindset. Okay, for example, let me tell you, here you see news, okay, and you see like festivals are approaching. So for example, in India, if Diwali is approaching, the stock of Asian Paint tends to rally, because everybody believes that Asian Paints, everybody is going to paint their houses, so the revenues of Asian Paints will increase, because of which this will rally. Okay, based on wars. Okay, now currently we are into the pandemic, so you'll see pharma stocks are rallying. Okay, so this is psychological analysis, a psychological approach of what people are thinking about particular sectors, particular stocks. Okay, so these are basically external factors that impact the mind of the buyers or the sellers. Okay, ultimately, all this, whether it's fundamental, whether it's technical, whether it's psychological, there is one factor common in them. whatever may be the reason. Let's say the company is doing very good, the company is doing very good, or the stock chart is supporting it, technical chart is supporting it, or there is some good news, whatever it is. If this impacts the buyers and if it leads to heavy buying in some way, for example, it leads to heavy buying because of a good news, or because of the company has done very well and the reports are out, the results are out, and the company has done very well. When it results into heavy buying, this heavy buying creates demand, and whenever demand is created from that particular level, the stock prices start to shoot up. But let's say on the other hand, this news or the fundamentals or the technicals, due to some reason, create supply, heavy selling. This creates in turn supply, and this supply leads to fall of prices. So what we believe is, whether it is fundamental, whether it is technical, whether it is psychological, okay, it's all a game of demand and supply. Okay, in the stock market, it's all a game of demand and supply. So if there is heavy buying, demand is created, stock will go up. If there is heavy selling, supply is created and the stock prices will fall down. That's it. What we believe is this chart speaks about all the parameters. Now, for example, you have sudden rise in the stock prices from this level. So why did the stock suddenly start moving up? Because demand was created over here. Okay, or from here the stock started coming down. Why? Because demand was created over here. Why this demand and supply was created over here? Various reasons. Maybe some good results came out, maybe some good news came out, or heavy buying. Anything that leads to heavy buying creates demand, and demand takes the prices up. Anything that leads to supply, heavy selling leads to supply, and that brings the prices down. Okay, so these are your types of analysis that you perform: fundamental, technical, and psychological. Okay, we have a totally different approach at StockTech, where we teach our students to how to select fundamentally best companies and analyze their stock charts with a psychological approach to get the best results out of it, right? So the various types of analysis that are performed in the stock market are your fundamental, technical, psychological, and demand and supply. So whichever analysis you perform, that analysis is performed just for the three levels, and those three levels are buy level, stop loss level, and target. And depending on the type of analysis you're performing, investment is divided into terms. For example, long-term investments. Basically, the investors prefer this type of investment. Time period is month to week. The target here is huge capital gains and dividends. Then we have the midterm investment, where both investors and traders prefer this. Time period is few weeks to few months. Target is capital gains and dividends. Short-term investments. Okay, full-time and part-time traders basically prefer this. Time period few days to few weeks. Target is only capital gains. Not many are targeting, dividends, etc. Then BTST, buy today, sell tomorrow. Time period one night. Target is only capital gains. Intraday buying and selling on the same day. Now, if you're trying to use fundamental analysis, you cannot say, oh, the fundamentals of the stock is good, it will go up today itself. No. If fundamental is good, you can say, okay, in a few months it will go up, or in a few years it will go up very nicely. Okay. So that is how you define. But technical analysis can be best used for intraday, BTST, and short term. They might not work so well for midterm and long term. So this is how, based on the type of analysis that you do, your investment period is defined. Okay. Now, based on the investment period, you are classified into an investor or a trader. So if you are a person who buys the stock and leaves the stock for longer period of time, such people are known as investors. Who's a trader? A trader is a person who is interested into the daily fluctuations, that is buy, sell, buy, sell, buy, sell, and so on. So this is difference between an investor and trader. When you're trading in the stock market or you're investing in the stock market, there are different types of investors. You have institutional investors, that is the FII and the DII, foreign institutional investors, domestic institutional investors. We are the retail traders, and along with us also these institutions, etc., are also trading. When we are trading, guys, we are traders. So anybody who wants to get into trading, okay, they have, or investing, they have to face a major thing, and that is known as psychology. Psychological aspects. Every investor has to go through this, and there are two emotions that impact every investor, every trader, that is fear and greed. What happens in the stock market, okay, is when you're trying to buy the stocks or when you're trying to sell the stocks, there are a lot of questions that appear in your mind. You see a stock and you're like, should I buy, should I buy, should I buy? But in some time, okay, the stock starts moving up, so you get excited, oh, it's moving up, I did not buy it, and you jump and buy the stock at a higher price, and then the stock keeps coming down. So when you're in profits, should I take the profits? No, it goes down to losses. And now where you're on your losses, should I sell or wait for it to go up? So you wait for it to go up and it goes further down. So this is every day happening with every trader, investor, mostly with the traders. Okay, so why this is working, what is happening behind the scene? Okay, so let me tell you why people fail over here. The reason is there are a lot of factors that affect our psychology, like news, sentiments, festivals, calamities, wars, astrology, attachments, favorite, this stock is my favorite, that stock is my favorite. So there are so many things. Good news comes in, we tend to buy the stock. Bad news comes in, we tend to sell the stock. So there are various parameters that affect the psychology of any human being, any trader. Okay, but majority of the people, you ask them, they end up making losses in the stock market. Why? Because the approach itself is wrong. Let me try to explain this to you. Let's first understand what you can control in the stock market. What you control in the stock market is risk. So for example, how do I control the risk? If I'm buying the stock at 100, I put a stop loss at 96, so I'm taking a 4 rupees risk. So risk is in my control. If I'm buying the stock at 100, I put the stop loss at 94, 6 rupees risk. I buy the stock at 100, I put the stop loss at 90, 10 rupees risk. I analyze the stock and the stock says entry is 100, stop loss is 70. So I'll not take that trade because risk is 30 rupees. So it depends on me whether I'm taking that risk or not taking that risk, whether I'm putting a stop loss and restricting my risk, or I'm just keeping it open and taking a full risk. So I can control my risk. Can I control my cost? Yes. For example, there's a stock and I want to buy that stock at 100. Now you cannot, like, just bring it down to 100, obviously, but you can wait for the stock to come down to 100 and then buy it. But if not, you can look for an alternative, same category of stock which you feel is undervalued, and then in some time it might go up. So you can target such a stock. So you can control your cost. You control the time in the sense the period, waiting period in the stock. So if you have bought the stock, whether you want to keep it 1 day, 1 year, 1 month, 1 week, however long you want to keep it, this time is upon you. And your emotions, obviously you control your own emotions. Guys, this is a very, very important slide, so pay attention. So you control your emotions. But what you cannot control is the returns. Whether the stock is going up or whether the stock is going down is something that you cannot control. But people rarely focus on risk management, cost management, time management, and emotion management. They are only focused on returns management. That is why majority of the people lose money over here. Okay, when I say this, what I mean, I'll give you an example. Let's say you are driving a car on the highway at a full speed, and there's a person who walks in between the road. Now, when you're driving the car, what you control is you control the brake, you control the gear, you control the clutch, and you control the accelerator. What you don't control is that person in front of you. But here, what people are trying to do, they don't concentrate on what they are controlling. For example, if somebody is walking in, there are two options. First option, number one, you slow down. Okay, you deaccelerate, you slow down, you apply the brakes, you gear down, and you try to bring the car to a halt or slow it down till that person passes. That's step number one. This is in your control. You can do it. You can at least try to do it. But the second part, trying to control that person, peeping out of your window and abusing him, get out of the way, you fool. This is also a way. You can do that as well. But which is the better one? Which is the correct one? The number one is the correct one, right? But majority of the people here are not doing number one. They are concentrating on number two. That is peeping out of the window and abusing the person in front to get out of the way. So this is exactly what people are doing. You can control the risk, you can control the cost, you can control the time, and you can control the emotions. But what you cannot control is returns. And people are just concentrating on returns. Talk to a person. Will you invest in stocks? Kitna dega? No, that is a wrong question that you are asking. Kitna dega? Pehle ye pucho, if I am investing, how much is my risk? कितना जाएगा, अगर जाएगा तो कितना जाएगा, रिस्क कैलकुलेट करके फिर इन्वेस्ट करना है, एंड देन यू आर गोइंग टू फोकस ऑन द रिटर्न्स. इफ यू डू दैट, okay, you will succeed. But majority of the people fail to do that. So there's a 90-90-90 rule of the stock market. If you just Google it, you'll get an idea about it. It roughly says that 90% of the people lose 90% of their money in first 90 days in the stock market and are out of the stock market, because these people entered stock market with a wrong approach, just focusing on the returns. This is not exactly how the stock market works. This is not exactly how the stock market works. So who are these losers and why do they lose? The losers are retail traders like you and me. We are untrained, we have very little knowledge, no experience, no professionalism, very unorganized, aggressive trading. Aaj baitha hu to I'll trade something today based on tips, news, etc. We do not have a perfect strategy to trade. We are just randomly trading. So this is not exactly how it works out. So this leads to losing our money. And a lot of people can even go bankrupt into the stock market if they are doing that, right? So why this is happening with us? See what happens, how our general mindset works is pay very close attention to understand this. How our general mindset works, what we do, we see a stock that is going up. Oh, it's going up nicely, nicely, nicely. And we buy the stock here out of greed. We buy the stock here out of greed. And when you buy the stock here out of greed, now what happens is the stock has already rallied and you bought it over here out of greed. Once you buy it out of greed over here, now suddenly the stock starts going down. The stock starts going down. And you panic looking at the losses that you're making, and in panic and in losses, you sell off the stock over here. And once you sell off the stock over here, again the stock starts rallying up. So basically, we are buying higher because of greed and we are selling lower because of fear. And this cycle keeps repeating till we go broke. Now, what I'm trying to tell you over here, this is in front of the scene. Everybody knows this. Most of you might be watching this video after losing money in the stock market. Those who are not are lucky enough. Okay. So you might be watching this video now. So this is greed, buy, and this is fear sell. But what I'm trying to tell you, when you are buying here out of greed, you can only buy a stock when somebody is selling it to you. So my question to you is, when you are buying the stock here out of greed, who's the smart guy selling it to you here? It's obvious that when you are buying a rallying stock, there's some guy who's selling it and exiting out of it. And when you are selling it at a lower price, there's some smart guy who's buying it out of you. So who are the smart guys who are doing the smart trading, right? So the smart guys are traders who have exact risk management techniques with them. What are risk management techniques? Let me tell you. Risk management techniques comes with perfect strategies. We have various strategies at StockTech. Also, we have our master strategy. We called it the trend setting strategy. Okay, before going to that, let me explain to you what are the survival keys any smart trader should know. Any smart trader should know where to take the entry, exact entry. Sometimes what happens, people take wrong entries. They will enter the stock over here and then the stock goes down rapidly. Imagine a person taking an entry over here and then the stock going down rapidly. He will lose a lot of money. Okay, so a person should know an exact entry, where to take the entry. And once you take the entry, the person should also know where to put a stop loss. Okay, that is, if the stock is going against him, that means a trade is going against him, is failing in the trade. So if I have bought it at 71, if I put at 69, if I'm buying 100 stocks, it will be a loss of 200 rupees. If I'm buying 1000 stocks, it will be a loss of 2000 rupees. So I should know where to restrict my losses. And if the stock is going into my favor, I should also know my target. For example, in this case, we have identified 78 as the target. So if the stock is going up, I should know that if I have bought 100 stocks, I'll be in a profit of 700 rupees. If I have bought 1000 stocks, I'm in a profit of 7000 rupees. Then at every single stage, when the stock prices are rising, the person should know how to trail at RS to R. This is a very important concept of trailing and booking half that we also teach. Okay, booking half, when to book half. Like for example, let's say you have bought 1000 quantities and the stock is going up, but suddenly you see markets are not doing so well. Markets have become like sideways, no movement at all. So it's better to sell 500 quantities here. So whenever you sell those 500 quantities, this 50% profit is all yours, all yours. So this is called booking half. What is trailing at R is to R? When the stock prices starts moving up, you will start increasing your stop loss. So this is called trailing. Another very important aspect. For example, let's say the stock is here and you put the stop loss here. That is called trailing. Trailing is with the increase in the stock price, you're also increasing the stop loss. So you had taken entry at 78, 71, stock is at 74, you are in profits. So you don't want to lose those profits. So you put a stop loss at 73, restricting it. So even if the stock comes down, it will get sold off at 73 and you are out of the trade with profits. And then even if it comes down, it doesn't matter to you. But let's say you trail at the wrong level. So if you trail at the wrong level, the stock will hit your stop loss and it will go and hit the target. You are out of the trade, but the stock went high. So you should know exactly where to trail. So taking the entry, take perfect stop loss, identifying the targets, trailing and booking half is what exactly a trader needs. It's a combination of all this. If any person trades with all this, trust me, they are going to get good results out of it. Because what happens in the stock market, let me tell you, there are many misconceptions in the stock market. The misconceptions are like you need a very high accuracy. Misconception number one, trust me, very high accuracy is not possible at all in the stock market. You will not be able to get this very high accuracy that you think of in the stock market. Why I say that is because predicting the stocks at different levels becomes very difficult. Okay, so any analysis you apply, any strategy you apply, okay, let me tell you, if your strategy has good risk is to reward ratio, if your strategy, the strategy that you use, for example, I told you we use trend setting reversal pattern strategy. Okay, so if you have a strategy which gives good risk to reward ratios, then accuracy even 50% is okay. So what does this mean? What does this mean? Let me try to explain this to you. Okay, so let's say I am buying a stock at 100 rupees. My strategy, okay, my strategy tells me that you can buy the stock at 100. The stop loss in the stock is, let's say, 96 rupees. So when I'm buying a stock at 100 rupees and my strategy tells me that the stop loss is 96 rupees, 4 rupees is the risk in this case, 4 rupees. So the reward, that is my target, remember, it should be at least 108 rupees. That is only when you should take the trade. So this my target, if the stock goes up, it should at least go up till 108, 108. Only then this strategy is called a strategy with a good risk to reward ratio. This trade is called a trade with a good risk to reward ratio. So this stock that is moving here, if I am buying it at 100, if the risk is 4 rupees, the reward should be at least 8 rupees. Because if it is less than 8 rupees, my risk to reward ratio won't work out. How risk to reward ratio is calculated? 4 ones are 4, so that's 1, and that's 2, right? Double. So 1:2 is the minimum risk to reward ratio you should have. That is called your R:R, risk to reward ratio. This should be minimum 1:2. So what I'm trying to say, if risk is 1 rupee, reward should be 2. If risk is 10 rupees, reward should be minimum 20 rupees. Only such trades are good trades, minimum. If risk is 5, reward should be at least 10. So risk to reward ratio of 1:2. So if your levels, if your analysis, if your strategy is giving you a risk to reward ratio of 1:2, only then your analysis, your strategy is a very good analysis. It's a very good strategy. Okay. If it is not achievable in your strategy, then this is not a good strategy to trade with. At StockTech, as I told you, we trade with a strategy which works on trend setting patterns. And in this strategy, we believe that stocks, okay, stocks, when they change trend, they leave some patterns. Okay. And we work on this patterns. For example, a stock that is in uptrend, okay, uptrend in the sense a stock that is moving up can move down. Okay. And a stock that is moving down can move up. Okay. So while doing this, this stock makes some particular patterns over here. So in our strategy, we specifically identify these patterns. We specifically identify these patterns and we trade only at these patterns. And we get very good risk to reward ratios. Very good risk to reward ratios. As I told you, the importance of risk to reward ratios. Now, even if you are trading with a risk to reward ratio of 1:2, guys, let's say you take 10 trades. Out of 10 trades, you win 5 trades and you lose 5 trades. That is, whenever you're winning a target, whenever stock is reaching a target, you're making 2 rupees because 1:2, 2 rupees. And whenever you're hitting a stop loss, you're losing 1 rupee. If this, in this way, my accuracy is 50%. Let's say I'm winning 50% of the trades and I'm losing 50% of the trades. If I still go on like this, which I will actually show you in a portfolio. So keep watching. You will see a live portfolio of one of our students who has done this and who has achieved amazing results. Okay. Amazing results. So you win 5 trades, you lose 5 trades. Whenever you're making money, you're making 2 rupees. Whenever you're losing money, you're just losing 1 rupees. So you'll still be in a profit of 5 rupees, 50% accuracy. That's it. 50% of the trades failing, 50% of the trades winning. Yes, there are people who claim that they have 100% accuracy, 90% accuracy. See, I'll tell you one thing honestly. We have not achieved it till date and we don't really know how they achieve it. Accuracy is not the key over here. The key is your risk to reward ratio managements, your perfect fund managements. Okay, that also will be learning. So we do not concentrate on just risk to reward ratios. We also concentrate on fund management along with this, right? But you know how these ratios work. If your ratio is 1:2, you lose 50% of the targets, you win 50% of the trades, you'll still be in a profit of good money, right? So like, for example, we have just put up some images, some very wonderful trades that we have taken. This is a stock called Reliance Communication, which we had put up at a price of 10 rupees 50 paise, 10 rupees 50 paise, right? So now 9 rupees 50 paise was the stop loss. So we are buying it at 10 rupees 50 paise on 17 May 2018. And if the stock goes down, we will sell it off at 9 rupees 50 paise. So we will take 1 rupee loss. But let me tell you what happened next day. Next day, the stock went up crazy to 21 rupees 55 paise. You can just open the charts and check it out. We have suggested this. Now, what happened over here is the stock went up superb, amazingly. Okay. And when the stock went up amazingly, it was a risk to reward of 1:10. 1 rupee was the risk, 10 rupee was the reward. So 100% returns in just 24 hours. Money doubled in 24 hours. 24 hours. suggested on 17th May, and this is what happened on 18th May, right? So risk to reward ratio of 1:10. Okay, we have not done it once or twice, we have done it multiple times. Okay, every month we post our reports on our free WhatsApp groups, guys. We have free WhatsApp groups also, which you can join, and on this free WhatsApp groups we keep posting this reports every month. Okay, and on this reports you will be able to see how this risk to reward ratio works with a perfect strategy. Now I'll show you some examples from our student group. As I told you, we have some student group for people whom we have trained. So you can see we have student group 4, student group 3, student group 1, student group 2, and plus we have general marketing group, stock tech 3, stock tech 1, stock tech Belgium, corporate, Pune and Bangalore and Mumbai. For various cities we have groups. On this groups what we do is we give suggestions for study purpose, so people can study this. Okay, here you can see personal view. So we had suggested Amraja batteries for a study purpose of 726. You can see the stock current value was 726. If you had traded with this stop loss, what you could have achieved. Okay, and so on, right? So this is how we are suggesting. Based on this, you can also see our students are taking trades and they are making profits. Here you can see we have a student called Akash, and Akash says today's profit in equity thanks to stock tech. You can see 3,780, 1050, and he's made a loss of 350 rupees also. But that's a one-day profit for him, right? With a perfect strategy, he's traded and he's making good money out of it, right? So this is how people trade. Now here I'll show you. Okay, so today's big achievement after a struggle. Thank you for your support. With patience, strong dedication, and good support from StockTech, anything can be possible. Thank you, StockTech team, and thank you for the members in the group for the wonderful trade updates. I am in the great experience. Thanks for the direction. You guys are superb. He made a profit of 43,000 rupees in a day. 43,000 rupees in a day. This is how our students are earning, because they have a perfect strategy to trade with. Okay, 27,000 rupees in a day, 27,000 rupees in a day. So various students making various profits. We guide our students how to trade. So for example, you can just check out, this is how our interactive our students group are. Every students in interacting, you can see we are putting up analysis, we are putting up sub charts. Here our students are making 30% gains in a week, just in a week. Iris, thank you, StockTech team. So he's making a profit of 6,109. Okay, we have various students who are making amazing profits. Let me show you some profits how our students making. Now if you see this profits by our student, you can see he's making a profit of 6,95,000 rupees. This is gigantic, enormous profit. We have a student called Saurabh who is also making very good profits. So Saurabh was performing well, so we asked Saurabh to share his monthly report with us, monthly profit and loss report with us. So he has shared the monthly profit and loss report with us, and you can see he's making a profit of 1,42,000. Anybody who wants to see this report, we have put up their trading report itself, that is downloaded from their account. Okay, you can just go to our website www.stocktech.in, our website. You have the reports over here. There's Santosh, who's made a profit of 1.10, that's 1 lakh in the month of June. If you want to see his trading report, you have an option to click here, and when you click here, you will get the report from Zerodha, not by StockTech. Zerodha, that is the trading platform. All the trades he has taken, and you can see the profit and loss. Here Uzma, a 22-year-old student who's making a profit of 62,770 rupees in the month of June. In 1 month, you can see the dates. That's 18/5/2020 to 11/6/2020, not even a month exactly. Okay, we have one more student who's making 1,49,000 over a period of 3 months, engineering student, right? And we have Saurabh, who's making very good money. Okay, let me show you one more recently. Okay, and that was Ravi. Okay, he has given us a review. So here, I just wanted to express my big thanks to QD, Sumit, and the StockTech team. Though calls were not suggested by the admins, but you gave me the wonderful platform for trading. Then I excelled myself into option strategies. There I used the zone strategies, our strategy, from the heart. God bless you and your team. Please share your knowledge to as much as possible. Thank you so much, QD sir and Sumit sir, once again. So he's thanking the trainers because he's made a big profit of 34,000 rupees in a day. Right? So this is how the mechanism works. This is how people are making profits. This is how people are earning from the training. How are these guys able to achieve it? These guys are able to achieve it because of the perfect course content that we have. You can go to the course content page and check out the syllabus for the course, what syllabus we have. If you want to check out testimonials of our students, how our students are performing and what they have to say, you can go to our testimonials page and you have hundreds of testimonials over here. You can just check them out, right? We have so many people making profits. Now, as I promised you that we will be seeing one of our student portfolios. So I am on the Zerodha trading platform. When I talk about accuracy, I want to show you guys this. We are on the Zerodha trading platform, and on the Zerodha trading platform, let me go to console. Console is where I can see my profit and loss. Okay, so this account is currently 1.61. Okay, so is there any payouts? Yes, recently we have paid out some amount, that is withdrawn some amount. We have withdrawn 30 cash. Okay, 1 minute, let me just check that out. Some amount over here, and we have withdrawn some amount over here. So we have been withdrawing profits from this account. So I'm just showing you a small account with 1.61 lakhs profits. Now let me go to reports, and there's something called profit and loss report over here. So when I go to the profit and loss report, let me show you the profit and loss report for the month of June. Okay, so let's start from April itself. April. Okay, that is financial year. So let me start from April. Okay, from 1st of April to 30th of April is what report I am building. Okay, 1st of April to 30th of April. So in this month, we have made a profit of 56,000 rupees in this account. Our student has made a profit of 56,000 rupees in the account. Okay, so this portfolio, if you go 3 months back, it was just a 1.2 lakh portfolios, and then 50,000 rupees profit is what it made in the month of April. Let me go to the month of here. Let me see the last month itself, June. Okay, so I've selected 1st June 2020 to 30th of June 2020. Let me check out the report for this month, and you can see a profit of 73,000 has been achieved. Guys, even if you consider the portfolio of 1.5 lakhs, it's like 3,000. So that's 50% profits in 1 month. 50% profits in 1 month. So when I say it's 50% profits in 1 month, right? Now, what I want you guys to observe is he's made a profit of 73,000 rupees over here. But now when I said accuracy doesn't really matter, let's check out his trades. On one page, you have 20 rows. That means 20 trades. Let's check out the number of trades he has taken. 1, 2, 3, 4, 5, 6. Sorry, obviously there are 20 because they have mentioned over here. One row, one page, 1 to 20 trades. So 20 trades on one page. Let's count the negative trades only. 1, 2, 3, 4, 5, 6, 7, 8, 9, and that's a 10. 10 negative trades on page 1, which means out of the 20 trades on page 1, total 63 trades taken. Out of the first 20, 10 are negative, 50% accuracy. I'll go to the page number 2. Okay, watch this out. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, and 11. 12 negative trades, only 8 positive trades. Let me go to the next one. Okay, and when I go to the next page, third page, let's count the negative ones. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, and 12 negative again on the fourth page. Third page, let me go to the fourth page, 2 negative, 1 positive. So majority of the trades, as you saw, almost 50% of the trades are negative. Then people say, hey, the accuracy is 50%. How they are making profits? Guys, accuracy, who can achieve high accuracies in the stock market? If there were strategies which would give you very high accuracies, then everybody would have been a millionaire, a billionaire. It's about your risk management. With 50% accuracy, this person has made 50% profits in a month. 73,000 rupees is what he has made. 73,000 in a month. Amazing returns. And this is all a game of risk to reward ratio management, and not exactly accuracy of the strategy, anything. Okay, the risk to reward ratio comes with a good strategy itself. So now it's not that the strategy is not important. Again, the strategy comes into picture, because perfect risk to reward ratio managements come with a perfect strategy itself. So getting it, how it is correlated. Okay, so people are just running behind accuracy. I want good accuracy, good accuracy. Not everybody is, it is not possible for everyone to achieve accuracy. So even if you have low accuracy, 50-50 accuracy, you can say 50% accuracy, still our student is making huge profits out of it. So this is what works out. As I told you, if you go to our course content, we have complete syllabus for what we are teaching. Okay, that is the basics of the stock market and the technical basics, core concepts, how to use the charting tools. Then the main part is our trend setting patterns, that is the bullish trend setting patterns and the bearish trend setting patterns, identifying the perfect entries and exits for the stop loss, applying the filters. Then we have factors of safety, and we have an entire content on risk and trade management, reward management, and your fund management. So with a perfect strategy comes a perfect risk to reward ratio management, and with the perfect risk to reward ratio management, you get perfect trading techniques. So today we have shared basic knowledge with you, and we have also shown you how you can go with a systematic approach. That is over here. We have given you this step-by-step procedure. Okay, you can read more about it. You can follow us. We are coming up with more free videos also. And then you can, if you wish to join also, you can join our trainings. Thank you for watching the video. Have a good time, and see you next time with a new video, and hope that you guys are trading well. Please read the disclaimer again before we end the video. Thank you.